All right, so what should you look out for when you're borrowing money to finance the purchase price of a house? Now, let's just say you have no experience, you've never done a deal, or let's just say you're an Airbnb arbitrage, you're used to short-term rentals, but you want to do a flip, you want to get into flipping. Let's just say that. This would be my advice to you. The first thing you're going to look for is that you're going to look at the promissory note. What kind of terms do they want from you? Do they want a personal guarantee? Do you know what a personal guarantee is? Google personal guarantee on a loan. And you need to be real familiar because basically what you're doing is if you personally guarantee an investment loan, that means that if you can't pay them, they can liquidate other assets that you own to pay the balance of that loan off. So that could be your personal residence. This could be your car. That could be cash in your accounts. Could it be stock accounts? Yes. Now, usually what happens is if you buy a house, you try and flip it, you can't sell it for whatever reason, you can't make the interest payments anymore. A lot of people will declare bankruptcy, but the point of the fact of the matter is, no, I do not sign personal guarantees. I don't like them. There's other ways to compensate that money lender or that investor for the risk, but this is one thing that you need to take into consideration. If there's a personal guarantee behind that loan and you buy the house to flip it and you can't pay, that means that your other assets are exposed to it. So just keep that in mind. The other thing when borrowing money is what kind of fees are you looking for? I get a lot of hard money lenders DM me on Instagram. Hey, I got money to loan out, get X, Y, and Z. Standard across the board is 12% interest, APR, and 2 points. If you don't know what points are a percentage of the loan that is charged as an upfront fee. So if you borrow $200,000, that's $4,000 in a fee that you will have to pay. Usually you have two options. One, you can pay that fee, that $4,000 at closing, or you can roll that fee back into the loan. So now your loan is no longer $200,000, it's $204,000. And keep in mind, if your interest rate is 12%, you're paying 12% on that $204,000 now. Now, generally speaking, most hard money lenders will say, okay, you want to borrow a property with an after repaired value of $200,000 and it needs $20,000 in repairs. So we're going to loan you 70% of that $200,000, which comes to $140,000. And we'll basically not loan you anything more than $140,000. So you would have to get that property under contract for $110,000. You would borrow $140,000. You'll have to put down 10%. So let's say you have to bring like 15 grand to the table. That's what the loan is going to be based off of. So let's just call the loan, for now, let's just call it $140,000. If you want me to do an in-depth video and actually go through on a spreadsheet, let me know in the comments and I'll do that for you. Are they to do the repairs? A lot of times you can draw. And what a draw means is that they're going to hold that $20,000 in repairs in escrow. You're going to do the repairs. You're going to prove to them that you did X, Y, and Z repairs, and then they'll loan you the money. They want to make sure that you don't just take the 20 grand and leave. Are there draw fees? Do they charge you $300, $400, $150 per draw? Ask that. Ask it up front. The other thing is, now I told you about the interest rate. I told you about the points. What about transaction fees? A lot of hard money loaners are going to charge, like, let's just say $2,000. So if you're borrowing that $200,000 property and the loan is $114,000 and you're going to come up with 90% of that, keep in mind that 10% of $140,000 is $14,000. If you're going to owe $2,000, let's just say $2,000 in fees, so now you're at 16, and if you're paying 2 points on that $200,000, well, add another $2,000 on that unless you roll it back on the end of the loan. Don't worry about doing the math just yet. But just what I'm trying to teach you guys is these are some of the questions that you have to ask. Now, the biggest question I'm going to ask is what happens, how long is the duration of the loan? Is it 6 months? Is it 12 months? Is there a balloon or a call at the end of that loan? So if it's a balloon, that means that I owe them the total amount of the loan due on that day. If it's not in their account, I'm in default. I don't like that, because if I can't sell a property, now if they don't have that money in their account by X, Y, and Z day, that means I'm in default. What I will do is give them a call. Means that they have a right to call the loan due at 12 months, but usually they have to give me notice. I like it because there can be a number of circumstances that occur that are outside my control where I can't give them that to whatever it is, $200,000. It's usually because you can't sell it, but I am very wary of balloon payments. The other thing you need to take into consideration is what a lot of these companies will do is they'll put extension fees into the loan. Therefore, let's just say it's a 6-month, let's just call it a balloon. Let's just say you sign that balloon. A lot of them, if you can't pay them, they're not going to take that property back because they don't want to own real estate because that's a separate business. They're not in that business, but they're going to charge you a fee. And whatever amount of points you paid, so let's say it's 12% and 2 points, you're going to pay another 2 points at that 6-month period. Also, keep in mind with these large companies is that the interest is going to be paid monthly. How do you figure out what your interest payment? Well, they're going to tell you, but basically it is a per diem amount. So you take 12% on $140,000 divided by 365 days, excuse me, and then you calculate how many days in a month. So you will pay 31 days on a 31-day month, 28 days in February, 30 days in usually standard month. So you're going to be making those payments every month. Interest-only payments is what they call that. So you need to take into consideration, well, how much money do you have to have on the side to carry those interest payments? Front the money for the repairs. Some people do it on credit cards. I'm not saying you should do that, but I'm just saying some people do that. Those are probably the biggest things I would take into consideration if you're going to borrow money to flip a house. That's why I'm an advocate of the partnering strategy. You partner with a rehabber with much more experience that's been in the business, let's say 20 years, and you find the deal, you bring the deal to the table, they fund everything, and you split everything 50-50. It's far less risky, plus basically what we have is your own underwriter there. They're going to underwrite the deal. If they agree to fund 100% of the purchase price and 100% of the rehab and take 50% of the deal, it's because it's a good deal. So that's your underwriter. Now, keep in mind that you might have to bring them lots and lots and lots of deals that they're going to say no to before they agree to one. But once they agree to one, it's a good, more often than not, it's a good deal. And if you don't have any money in it and you didn't sign a personal guarantee, then you don't have any risk. So hopefully that's helpful. Any questions, put them in the comments. Go out there, start making some offers.